Good afternoon. I wanted to welcome everyone. I'm Corey Cottle. I'm the Chief Marketing Officer for Ag Georgia Farm Credit. We're glad to have everyone on today to be able to provide this learning opportunity. I think it's going to be very beneficial for any of our cotton growers. The idea for this webinar came about through our Stockholder Advisory Council last year. And a couple of our farmers said that there was a need for more education available for cotton growers relative to marketing, and that there were a lot of people who really weren't comfortable and didn't have a good understanding of options. So we reached out to our presenter to see if he could help us bridge that gap. So this is just something that we at Ag Georgia wanted to offer as a benefit to our members and cotton growers at large, to try to make sure that everyone's aware of all the possible tools to help you maximize the profits on your crop. Well, I know we have a large Ag Georgia group on, but I know we have some friends online today as well from our sister associations in the state, Ag South Farm Credit and Southwest Georgia Farm Credit. So if you're from outside Ag Georgia territory over towards Statesboro for Ag South or Bainbridge for Southwest Georgia, please call on our farm credit friends with those associations. If you're wondering who services your area, you can go to farmcredit.com and enter your zip code or county to find the office nearest you. So with that said, I'm excited to welcome our presenter, Dr. Don Shurley. And I say welcome and not introduce because there are probably very few folks on this call that are not familiar with Don. Many of you probably receive his periodic emails on the cotton market. Don is a retired UGA cotton economist with almost 35 years experience in cotton and is recognized as one of the nation's leading cotton experts. I actually called one of our farmers this morning to personally invite them to the webinar. And when he asked who was presenting, I told him Don Shurley. And he said, "Oh yeah, that guy's crazy smart." So I believe was the quote. So Don, your reputation precedes you. Couple quick housekeeping notes, and then I'll turn it over to Don. We have it set for everyone's mics and cameras to be off since this was open to the public. We're going to open it up at the end for questions and answers. So as Don is going through his presentation, just write those down and we'll open it up at the end. If you join via Teams, you can feel free to pop those questions in the chat at any time, and we'll get Don to answer. For those of you that join by phone only, when we get to the Q&A at the end, you'll, if you have a question, enter *5 on your phone to raise your hand, and I'll be able to unmute your mic. And then after that, you can press *6 on your phone to unmute and ask a question to Don. So as I mentioned earlier, this is being recorded, so you can go back and reference this later as well. With that, Don, I'm going to turn it over to you.
Thank you, Corey. It's a great pleasure to be able to do this, and I am very thankful for Ag Georgia Farm Credit for reaching out and inviting me to do this. It's a great honor. I worked with the University of Georgia for over 30 years, and I've been retired since 2018, but I still continue my cotton education and research work through industry and working through business and lenders like Ag Georgia. And again, I very much appreciate the opportunity to do this. I'm not going to pretend that I have a crystal ball because I don't, and I don't think that's the objective of us being here today. What I want to do is share my thoughts with you, share with you what I think I know, and generate some questions that you might have or some discussion that we can have that would be useful to you and worth you spending your time here with us today. I've got about 4 or 5 sections of things that I want to go over today. So let's go ahead and get started. Let's summarize USDA's numbers that came out last week. The USDA raised our U.S. crop, 2024 crop, just a little bit. They increased the yield, lowered the acres harvested, but increased the yield on the acres that we did harvest, and as a result, boosted the crop up just a little bit. Here's the kicker, and those of you that follow what I've written in media and other places, this was not unexpected. The U.S. exports for the 2024 crop year, which end at the end of July, USDA lowered those exports another 300,000 bales. And we'll talk about that a little bit more here in just a little bit. World production was raised 2 million bales, 1.8 million of that was in China. So USDA found another 1.8 million bales over there and added that to world production. A number that we keep very close eye on is world demand. And again, I'll share some numbers with you on this in a little more detail. Demand was raised slightly, not much, but slightly. The important thing here is it didn't go down. Anytime demand doesn't go down, that's a good thing in the environment we're in. Exports from Brazil were raised 300,000 bales. That's quite significant, and we'll talk about that a little further. And then production in Australia was raised 400,000 bales. Now, how is Brazil and Australia significant? Well, let's remember, and you may remember, Brazil and Australia are in the southern hemisphere. They are just the opposite climate-wise on the calendar than we are. So as we approach spring here in a few months and begin to plant, what will they be doing? They'll be harvesting, just the opposite from us. And all indications are that both Brazil and Australia have got some good crops coming on. And raising Brazil's export potential, raising Australia's production, both of those things are going to give the U.S. competition in the market for exports as we move into spring and summer months. Because again, as we're planting, they'll be getting their crop in, and it'll be available to put into the supply line. All right, let's talk about demand. World demand has actually grown for 2 straight years after being down in 2021 and 22. We've actually grown a little bit over the past 2 years, counting this year. Not much, but it has increased. Demand is still quite a bit from where we used to be. So we've got a long ways to go compared to where we were at one time. Here's another way to look at this. Look at the blue box up here, the blue chart up here. Another way to look at this is that demand has not lived up to expectations. And that's why prices are so weak. Look at USDA numbers here. Back in July, when USDA was making projections about what our exports for the 24 crop year would be, that number was over 117 million bales. Last week, when USDA released the numbers, the projections for this month, for January, for 3 or 4 or 5 months in a row now, we're below 116 million bales. So what I'm saying is, if you look at overall the big picture, yes, our demand is higher this year than it was last year. But the pace of demand that we're on, the world demand out there that USDA is estimating, has gotten weaker. We've lost almost 2 million bales, 1.5, 2 million bales in demand since last summer. And so the demand has been weak, has been less than expected, and that's helped to fuel the prices that we've seen. This chart, another thing that's important And I've talked to other folks about this. I don't think supply is a problem. We don't have an oversupply necessarily of cotton. Our problem is demand, not supply. Visually, kind of a way to look at this, if you look at the blue line and the purple line here, unless we go back 5 or 6 years ago, those lines match up pretty well. In other words, we're not producing a whole lot more cotton than we actually use. Occasionally, yes, sometimes we'll actually produce a little less than what we use. But those lines have matched up pretty well over the last 3 or 4 years. So visually, if I could paint a picture in your mind, it would be that supply is not our problem. Okay, our problem has been demand. This is another way to look at it, and this is the real problem. If I could ask y'all to remember one slide out of this particular section that we're going over, this would be it. This is what is called the U.S. market share. I'm going back probably 7 or 8, 9 years here. This is the amount of cotton that the U.S. exports as a percentage of the total world exports from all exporting countries. Now, look at 2017. Back in 2017, we had 17, 18, 19, up until 2020, the U.S. was exporting 35 to 40% of all the cotton in the world that foreign countries needed to buy. If you were a foreign country and needed cotton for your mills, 35 to 40% of it you got from the U.S. Now, compared to where we have been the last 2 years, we're down closer to 26, between 25 and 26% now market share. And you say, well, so what, Don? What does that mean? Well, this is important. And I think this is what's driving the weak prices that we've got. Demand is down, so the pie, let's put it this way. The pie has shrunk. World demand is down from where it used to be 6, 7, 8, 9, 10 years ago. The pie has shrunk. The pie is smaller. And on top of that, the U.S. share of that pie has shrunk. So the U.S. is now a smaller slice of an even smaller pie. The U.S. has now become a residual supplier of cotton, especially when and if Brazil and Australia have good crops. Brazil is now taken over as the largest exporter in the world. The U.S. used to play that role. We don't anymore. So, in trying to scratch my head and think about what is going on with regard to price and why are we so low? Why can't we do better? Heck, we're not even meeting our cost of production. Why is price not even at least where the cost of production is? And again, I don't think it's due to oversupply. I think it's due to the fact that demand is down. Even though it has grown a couple of years, you can look at that chart. We're still far from where we used to be. demand is down, and our exports, again, our exports represent purchases by foreign countries for their mill industry. And those exports, as a percent of total world exports, what we call market share, has shrunk. All right. Another way to look at this, and again, another angle on the same story. This is weekly exports. How much cotton the U.S. has sold and shipped every week since the beginning of this 2024 crop marketing year. Now, sales have been okay. I mean, we've had ups and downs, as you would expect. We've had some extremely strong weeks where sales have been over 300,000 bales. We've had some weeks where sales have been closer to 100,000. So overall, sales have not been that bad. The problem is shipments. Shipments is what we actually look at to determine kind of what pace we're on. If you look at the numbers up there in the red box, USDA makes projections in their reports every month of what our exports are going to be. If you look back to last May through July, if you look back to last summer, USDA was thinking, hey, we're going to export 13 million bales during this 2024 marketing year. Well, the report that came out last week, they've now adjusted that projection down to 11 million bales. Now, folks that keep track of the numbers, and I try to keep track of these, we knew this was coming. Because if you look at those weekly shipments, that's nowhere near. As a matter of fact, the pace we're on right now, we're not even on pace to do 11 million bales. So there's a chance that our exports are going to get lowered below 11 million, which USDA projected last week. We had a great report last week, the highest shipments that we've made all this year, this marketing year. But the pace that we've been on for most of the year just has been weak. China has not been a big buyer. China is usually one of our largest customers, but China's not buying. And that really has hampered our ability to export and to meet that market share that I'm talking about. Now, one good thing here, and I've had several growers that I know are listening that have mentioned, Don, we want you to say something positive. Here's something positive. The sales numbers, like I said, have been, for the most part, good to okay. The shipments have not been, but the sales have been good. Because the sales have been good, that gives us a reason to be positive that maybe the shipments will eventually improve. We've made the sales. We got to get it shipped out. So if the sales continue to be good, then maybe this portends that the shipments will eventually also catch up and begin to do better. Okay? So that's one thing that we have on the outlook that might give us a little bit of an improvement in price. But again, like I said, now come this spring and summer, we're going to be fighting Australia and Brazil in the export market. So that's something that we'll also have to contend with. I was asked to mention some things about the PLC payments and about the economic assistance package, which was recently passed, and let me shift gears and kind of do that. I haven't completely updated the numbers. I did update it for the price of cotton through last week's USDA report. There's a little bit of a lag. Their report on cottonseed prices and production doesn't come out until today. So these numbers have been revised somewhat, but they'll also change a little bit. Right now, the latest numbers that I had to work with, the U.S. price of cotton for the 2024 crop year is expected to average 65 cents. The last number I saw, and I can revise it later today, the last number I saw on cottonseed, the U.S. average price is expected to be $2.20 a ton. If we take those, price of cotton and the price of seed, the market year average price for seed cotton then would be projected to be a little over 34 cents. The effective reference price for seed cotton is 36.7. So the difference in that would give us a PLC payment on seed cotton of 2.41 cents. So we are expecting a small, but not too bad. We are expecting a PLC payment on the 2024 crop. And right now, the projection is what I've put together is about 2.4 cents, but that'll change a little bit. And it's subject to change as we continue to move through time, because the marketing year for cotton and cottonseed doesn't end until the end of July. So that number is still subject to be changed. But right now, it looks like we'll have a small PLC payment. We're also expecting a small PLC payment on peanuts. The latest number that I saw that I could calculate would be $5 a ton. So you see that we're expecting a PLC payment both on seed cotton and peanuts. No PLC on corn, soybeans, or wheat, but most of our corn, soybeans, and wheat base is enrolled in ARC and not PLC. Seed cotton and peanuts almost exclusively has gone into PLC. But so we are expecting PLCs on seed cotton base and peanut base, but nothing on corn, soybeans, and wheat. All right. This is a little difficult to read. There's a lot of numbers here, but this is what the seed cotton PLC payment rate would be, depending on what's the price of cotton and what's the price of cottonseed. For example, if you look at $200 a ton for cottonseed and run over to 70 cents for cotton, you see 0.9. So your PLC would be 0.9 cents. That's not 90 cents. It's 0.9 cents. If the price of cotton is down at, say, 66 with $200 a ton cottonseed, then the PLC is estimated to be 2.62 cents. And of course, you get that on your seed cotton payment yield on 85% of your base. One of the reasons I put this together, and I wanted to show you, to give you kind of an idea of, what we might expect for the 25 crop, but also to see that, the price of cottonseed to the best of my understanding and what I've been able to see and to find out, has been over $200 a ton for several years now. And $200 a ton for cottonseed, because that price gets weighted in with the price of cotton. The price of cotton's down. Yeah, we don't like where the price of cotton is, but $200 or more per ton for cottonseed, that kind of buffers that cotton price a little bit, and it increases what otherwise would be your average price for seed cotton. Seed cotton's the market your average price for seed cotton is a combination of both cottonseed and cotton. So the stronger prices that we've had on cottonseed the last few years has kind of weighted in on that lower price of cotton and kind of reduced what the PLC rate would otherwise be. All right, so we're likely to have a small PLC payment again for the 25 crop, much like it looks like it's going to be for the 24 crop. To be eligible for that, and y'all know this by now, you've got to have your seed cotton base enrolled in PLC. Now, if you're enrolled in PLC, if the base on a farm is enrolled in PLC, all the cotton acres planted on that farm are ineligible for stacks. You can enroll those acres planted in SCO, but they're not eligible for stacks. So we are expecting a small PLC payment again. If you wish to be eligible for such a payment, if we had one, your seed cotton base would have to be enrolled in PLC. But if it is enrolled in PLC, you won't be able to enroll the acres planted on that farm in stacks, but you can enroll those acres in SCO. If the acres that you've planted are enrolled in stacks, then the seed cotton base is ineligible for both PLC and ARC. Let me make a comment here specifically about one part of the Farm Bill. It's unfortunate that we're going 2 years in a row without another Farm Bill. We've extended the 2008 Farm Bill for 2 years in a row now. The 18 Farm Bill was due to expire after the 23 crop year, but it was extended last year, and we just extended it again. That's unfortunate because there's some things in that Farm Bill that need to be modified. One of the things that's been talked about is what you see here in this box that I just mentioned. Some of the linkages between how you enroll or what you enroll in with regard to ALC, PRC, and the crop insurance products that you otherwise are eligible for or not eligible for. There's been some discussion about modifying some of that. How they would do it, I don't know. I'm just telling you, there's been some talk about trying to make some modifications there to make it a little better for the farmer, or to make the choices a little better. I'll put it that way. Okay. I wanted to also touch on the economic assistance payments that are coming up. And again, my job here is to simply try my best to pass along to y'all the best thing that I think I know at this point, and that's what I'm going to try to do. The American Relief Act of 2025, that was passed. It contains a continuing resolution to fund the government through March 14th. As I just said, it extends the 18th Farm Bill for another year. It provides $31 billion in disaster and economic funding for agriculture. $10 billion of that is in economic assistance payments. And we're going to look at those. Producers will receive a one-time payment that will help to cover some of the problems and situations and economic and financial losses that we've got going on out there. So $10 billion in that. Now, I won't go through all these calculations here, but I wanted to just share with y'all how these economic loss payments will be made. If you can come back and look at these equations, but the bill that created these specified how it was to be done, where the numbers came from, and why they chose to use the numbers as they did. I don't know. I will tell you that you just don't sit down and come up with this overnight. Even though this bill was just passed a few weeks ago, somebody had to be working on this for quite a while to know that this would work and to know how much money the government would be spending on something like this. You've got an economic loss equation that is based on USDA estimates of cost of production. It's based on average farm price and yield for the last 10 years. And again, you can look through these equations here. The bill specifies how the economic loss will be calculated. This is what has been calculated for cotton. This is the payment. Now, the bill also says that USDA, it's giving USDA the authority to change this a little bit. But based on the calculations, based on the verbiage that is in the bill, this is what is estimated to be your economic loss payment on cotton. And again, the USDA has the authority to change this up a little bit if they so need to or want to. All right. The economic loss, you take the cost of production as estimated by USDA and subtract that, and from that you subtract what's expected to be what would have been expected to be the revenue, the national average price times the 10-year average yield. And so that gives you a loss of $336 an acre. And then you take 26% of that. The legislation says the loss will be 26% of that. So that's $87.36 an acre. Like I said, where'd the 26% come from? How did they decide that? I don't know. Somebody had to do a lot of work to know that, or to think about how this would work. So your economic loss payment on cotton will be $87.36 an acre. Now, these are what I call national rates. This rate on cotton, for example, 86.37, this applies to every acre of cotton planted. It's the same in every state. It doesn't matter if you're growing cotton in Georgia or in Mississippi. It's the same rate for everybody, everywhere. You take that 87.36, and that payment will be received on your acres that you planted, plus half of your prevented planted acres. So 87.36 an acre times the acres you planted last year, plus half of any acres that you were prevented from planting. And again, based on those formulas, these are the payment rates for the crops that, there are other crops that are part of this, but for what we grow in Georgia, for the most part, this is the payment rates of what's expected for the crops that we grow here. Now, my understanding is that these payments are to be made within 90 days of when the law was passed, when the bill was passed. So sometime between now and approaching the end of March, the payments are supposed to be made, if what I read is correct, or if I read it correctly. Okay. All right. Let's talk a little bit about, yes.
Sorry, that was me, Don. I was popping in quickly. I just wanted to say you had the limitation on there. I did want to note that if over 75% of your gross income is from farming, that your limitation is 250,000. There's a lower limit if less of your gross income is derived from farming, but it's if over 75% is derived from farming, it's 250,000 is the limit.
That's exactly correct. Yes, thank you. There are payment limitations, and as Corey said, it is based on your gross income. But yes, these payments are subject to limitations. Yes. Okay. Let me mention real briefly, because I know our time is going to run out here. I wanted to, and again, I'm not telling you anything here that most of you, if not all of you, don't already know. We know that marketing is not all about price. I mean, it can't be. Because we don't know what price is good or not good until it's already in the rearview mirror. I like to break things down, what I call pre-harvest and post-harvest. These are the things, for example, pre-harvest that you can do to try to price your crop or try to manage risk. What makes marketing so frustrating is that none of these things are perfect. You can make a decision to do nothing, to wait and price later, and that's fine. When you do that, you understand that obviously you're hoping for price to get better and you'll price later, but you're accepting the risk that price could go lower. The difference in all these things here, there's 5 things listed here pre-harvest. The difference in them is just, how they'll work out, and you never know how they're going to work out, and also how much risk that you're taking or not taking when you do these things. If you decide to forward contract or sign a bale contract at a fixed price, which most everybody does at some point, you're fixing a price on those bales. That's going to eliminate the risk or the possibility of you getting anything lower on those bales. But it also means that you're sacrificing the opportunity to get anything better. So there's a trade-off. You won't get lower, but you won't get better either. A basis contract, this is popular. A lot of y'all use these. A base contract locks in your basis, but you still got to fix the price, and you're sitting there subject to the price going up or down. So it's not much different than not doing anything. A minimum price contract, those things used to be available. They might still be out there some. But the last thing that you see there is a put option. And I was asked specifically to talk about options. And I will tell you that to really understand these, and some of you have used these, and more farmers are using them. To get a better grip on this, we really need to spend more in-depth time. I would recommend maybe doing something face-to-face and doing a little 2 or 3 hour workshop where I can put y'all through some numbers on these. But let me just give you one example here about how a put option works. Now, pre-harvest, you're going to use a put option rather than contract. Rather than sign that bale fixed price contract, you're going to go the put option route. Now, why would somebody do that? The reason is because the put option, when you sign a put option, when you go to a commodities broker and enter a put option, you're not committing to deliver your bales to anybody at any time. You're essentially just buying price insurance. Look at this example. Let's suppose you wanted to fix contract today, and I did this based on last Friday's close. Let's suppose you wanted to fix contract today. The December 25 futures is at 69, and let's suppose your buyer offered you a basis of 175 or 1.75 over. So you could contract at 70.75. Alternatively, you could purchase a put option. Let's use a strike price at 69. Again, this is kind of like insurance. You're buying insurance at 69 cents on cotton. You're going to pay a little over 4 cents for that, 4 cents per pound. So if you take your strike price, 69, add our basis to it, what we would expect to sell our cotton for when we actually sell it, let's say 1.75, and then subtract the premium, that gives you a floor or a guarantee that the put is offering you of 66.62. So if you buy this put, we're saying Mr. Farmer's not going to get any less than 66.62 as long as the basis is 175 over. And you say, well, Don, why the heck would I do that? I can go ahead and contract for 70.75. That's right. But when you contract at 70.75, that's what you're going to get. What if the price goes up? If cotton goes up, you get 70.75. With the put option, basically what a put option is doing, it's giving you less protection, 66.62 versus 70.75. It's giving you less protection, but in exchange for that, will give you the opportunity to do better than the fixed contract if price goes up. It doesn't mean you necessarily will, but it gives you the opportunity to do so. It depends on how much you have to pay for the option, and it depends on how much price goes up. Look at this example here. Look at number one over there on the top left. Let's buy the put. Strike price is 69 cents. It's going to cost me 4.13 cents. Let's fast forward to harvest. Let's suppose December futures has gone up to 75. All right. If my basis is 175 over, that means I'm selling my cotton for 76.75. All right. That put option, though, because the price has gone up, that put option's going to expire with no value. In order for a put option to have value, the market has to move down. Well, the market hadn't moved down, it's moved up. So that put is going to be worth zero. So I've lost my 4.13 cents that I paid for it, but I ended up selling my cotton on a 75-cent market. So if I take the 76.75 that I sold my cotton for, subtract the loss on the put, I net out at 72.62, which, if you'll notice, is more than what I could have contracted at. So what's Don saying? A put option is going to give you protection, but it's going to be less protection than you would have gotten through a contract. On this example, you can contract today for 70.75. The put is not going to give you that much protection. But if the market should go up, you'd be stuck with the 70.75 contract versus, in this case, netting out between 72 and 73 with the put. Will the put always do better than a contract? No. It depends on what the market does. Is the market going to go down or is it going to go up? If it goes up, how much? And what do you have to pay for the option? The whole idea behind puts is to give you some flexibility. Now, I was asked to cover puts and calls. Why? Look at what we just went through. Think about what we're going to have to contend with next year. How do you protect yourself from the market going down, but at the same time give you the opportunity to do better should the market go up? That's what puts are all about. If that's not where you want to be, if that doesn't concern you, then that is perfectly fine. I'm just trying to help you to understand what a put option is all about. It's about flexibility. Will it give you as much protection as a contract? No. This put option right here locked in a floor or guarantee of 66.62. Well, heck, you can go ahead and contract for 4 cents better than that today. So why go through all this? Because you don't know. We don't know what price is going to do. And the put, when you go the put option route, you're willing to pay the money, 4.13 cents, for the opportunity and flexibility to do better if the market goes up. In a fixed price contract, you're stuck. With the puts, you aren't. All right, very quickly. Post-harvest, these are the things that you can do. Y'all are all familiar with this. The deferred price or provisional contract, depending on where you are, depending on what buyers that you deal with, can be very popular. It's called by different things. I call it a deferred price contract. Some people call it a provisional or put in your cotton on call. I call it a deferred price, but it all works the same. One of the things you can do post-harvest is to go the call option route. And again, what you're going to do with the call option, you're going to go ahead and sell your crop and buy the call. Rather than store, go ahead and sell the crop and then turn around and take a little bit of that money out of your pocket and buy the call option. What you're doing when you buy the call, you're substituting the cost of the call, the premium that you will pay, for the cost of storage. Rather than pay for storage, you pay for the call. Either way, what you're doing is buying time. If you've got the crop in storage, if you put it on a deferred contract, if you buy an option, anytime that you delay selling, that you defer selling until later, it involves some form of buying time. When you buy the call option, you're buying time. When you store the crop, you're buying time. So what you're going to do with the call, let's look at this example. Number one, you sell the cotton. Let's suppose you sold let's sell the cotton today. Again, this is based on last Friday's prices. Last Friday, March, was at 67.21. Let's suppose your basis is 2 over. Now, this depends on where you're at. It depends on fiber quality. We all know those things. But let's suppose your basis was 2 over. That means you had an opportunity to sell at a little over 69. Suppose we go ahead and sell the cotton today, 69 cents. We turn around and buy the call. Let's buy the call. Let's reach out to May futures and buy a call with a strike price of 69 cents. All right, let's fast forward. Suppose May increases to 72. The market has increased above my strike price. My strike price on the call is 69. Again, think of a call as insurance. You have insurance at 69 cents. We want price to go up. That's when the call is going to have money. So I bought the call for $2.16 today. Let's fast forward and suppose May goes to 72 cents. That call is going to be worth 3 cents, if not more. That 3 cents is what we call its minimum value. So it's worth 3 cents because the market's 3 cents higher than my strike price. Minus what I paid for it, I net out a profit of 0.84 cents. Take that 0.84, add that to what you sold your cotton for, and I total out a little over 70 cents. Now, the idea about a call, and again, more and more farmers are using these. The thing about a call is if you buy the call, you want the market to go up, just like you would if you were storing. You want the market to go up. Suppose you bought the call, but the market didn't go up. All right, then the call is not going to have any value, and you're going to lose your premium. And you deduct that from what you sold your cotton for, and that's what you end up getting. The difference between a call and storage is if you buy the call and the market goes down, all you're going to lose is your premium. If you're storing and the market goes down, you have paid for the cost of storage and you have lost value in what you actually have produced and stored. That won't happen with the call because you've already sold your crop. The difference between a call and storage, the call is going to let you play the market up if it will go up, and nobody has control over that. There are no guarantees. A call is going to let you play the market for the opportunity for it to go up, but limit your losses should the market go down. You don't have that with storage. You stick your crop in the warehouse out there and store it, your future is unknown. Your losses are potentially unlimited because you'll not only pay for the cost of storage, but also lose value in what you've got stored. So a call is used as an alternative for storage. Nothing's guaranteed. It may not work out better than storage. But the difference is in the risk that you take. When you store, you still risk the price going down and how that affects the value of what you've got in storage out there. With the call, you could still lose money, but all you'll lose is the premium that you pay. That's the difference. That's the difference. All right, very quickly, some thoughts on the remaining 24 crop, and then let's look ahead to 25. I don't see any signals out there right now that indicate that we're going to have any significant improvement in prices. I do think, I do believe that if exports begin to trend up, and again, like I told y'all earlier, sales have been okay. Sales are good. It's the shipments that are lagging behind. If the good level of sales is an indication that eventually shipments will also trend up, then that's good. I think some improvement is possible if exports begin to trend up. But even so, I think our prices are limited at most to, say, the 75-cent area, 73 to 75, maybe 76 cents. So I just don't see anything with an 8 in the front, unfortunately. But again, that doesn't mean that prices can't improve. They can. But we're going to have to see some improvement in exports to make it happen. As I've mentioned, Brazil and Australia are going to give us some resistance in price as we kind of move into spring. And China has just been a big disappointment so far. They're not buying. I don't have the numbers right here in front of me, but the last numbers I saw they're just way, way, way below what they normally would be and should be at this time of the year. So your remaining choices, sell it now and move on. I know we hate to do that because we always think we're at the bottom when prices are like this. I'd hate to see you sell now and move on, but it is possible that, if we continue this weakness we're in, maybe we test 65 cents. But one of the things you can do is sell and just move on. But again, you'd be risking this move to 65, but you'd also be giving up the opportunity to get something better should it come along if we break back above 70 cents. You can store. You can go to the marketing loan. If you need cash flow, that's one way to do it. You can still play the market, just store it in the loan. You're still subject to the price going down, but that's a possibility. You can do the deferred price option. You could save storage costs doing that, but again, you're risking the price going down, hoping it'll go up, but it could go down. And you could go the call option route, like I mentioned. Go ahead and sell it, turn around and buy the call. There's no guarantees that you make money doing that, but you'd be limited on you'd be limiting your losses should the market continue to go down, and possibly do better if the market goes up enough. It goes up at least more than what you're going to pay for that call. These are the cost and net return estimates that are put together by the UGA ag economist. This is for irrigated and non-irrigated production for this next year. You see the average prices and yields that they assume. These net returns that you see here are just considering the variable cost. What are variable costs? That's just money directly out of your pocket. That doesn't include any land payments, machinery payments, anything else. It doesn't include the owner-operator cost and family living and all that. It's just your direct operating cost. So that net return there, and that net return, those costs don't include land rent. UGA does not include land rent when they put these costs together. So that net return figure there is what would be left over if you're on rented land, if you're on rented ground, That would be the money left over to pay the rent, to pay yourself, to pay off other debts, other fixed costs. And you see those estimates there for both irrigated and non-irrigated. Okay. Now, these numbers may be a little hard to see, but this is the table that I put together that shows, okay, if I was on rented ground, if I was paying land rent, depending on what my rent is and what my yield is, what price would I need on my cotton to pay those variable costs that I just showed you, plus the rent? Let's look at the top table here. Suppose your land rent's $200 an acre. Suppose you make 1,200 pounds on irrigated cotton. That's roughly just under 69 cents a pound you need to pay your variable costs, seed, chemicals, fertilizer, fuel, repairs, all that stuff, plus your rent. You need roughly 69 cents. So that's how you interpret that table. Based on what your rent is for irrigated and your yield, here's what price you need to pay those variable costs plus your rent. And you can compare that to where the market is. Look at non-irrigated. Suppose you make a bale and a half yield, that's $7.50. And suppose you paid, say, $100 an acre for rent. Then you would need roughly, based on UGA cost estimates, you would need roughly 79 cents to pay those variable costs plus the rent if you made a bale and a half. So again, I put this together to kind of give you an idea. I would highly encourage you to go through and do this on your own for your own situation. But budget out what your cost and situation is, and then think about where the market's at and think about what you can do to kind of minimize the risk as best you can. All right. So what do we do for 2025? I would absolutely love to get some feedback from y'all. How do you plant a crop? How do you produce and market a crop that you kind of think right off the bat you may end up losing money on? How do you, what's your strategy? What's your thoughts on how do you approach 2025? Y'all know how to answer this question much better than I do. How are we going to do this? These are just some things right off the top of my head that I thought about. If we do get some sort of improvement in price, and again, I'm thinking 73 to 75 cents. To me, that would be an opportunity, but I know it's tempting not to do that because you're waiting on something 80 or better. I know how it works. But you have to start pricing and eliminating some risk at some point. Here's what I'm thinking, and this is where I'll end up with y'all. We're going to start seeing some acreage estimates come out here over the next couple of months. Cotton Grower Magazine has already put out a number. They're usually the first ones. The National Cotton Council will come out with their survey-based acres planted number here. I don't know the exact date. I don't have it here in front of me, but it'll be during their annual meeting in February, early part, first or second week in February. USDA will come out with their number the end of March. Everybody expects that number to be lower than it was this year. I don't think it'll be that much lower, simply because there are a lot of reasons that the acreage doesn't go down as much just because price goes down. Depends on what your alternatives are. You got crop rotations to consider. You got parts of the country that just don't have much alternative other than cotton. Growers are invested in ownership of gins and warehouses. So it's to their advantage to have cotton going through that facility. I think most people expect acreage not to drop very much this year, not drop more than say 10% or so. When those acreage numbers start to come out, if that acreage is lower, depending on how much lower it is, that likely will give price a little boost. Okay, if you're still holding 2024 crop, or if you're looking ahead to do something with the 25 crop, these acreage numbers, as they begin to be released over the next month or two, are going to present an opportunity for the market to bump up. And I think it will, if that number is low enough. But the bump up that we get in price is probably going to be limited. Again, I'm thinking 73 to 75 cents. So that would be your first opportunity to make a pricing decision at something that's better than what we've got right now. I'll put it that way. So that would be your best one of your first opportunities to do something. That's all that I have, and I know that we're probably way over on time, and I apologize for that. But I just simply wanted to share my thoughts with y'all. I don't have a crystal ball. I wish I did. Nobody does. I'm just trying to share my thoughts with y'all and hopefully provide something to you that'll help you think, help you to make some decisions a little better, a little easier as we kind of go forward. It's a tough time right now, and cotton's really struggling. And hopefully, if the demand side turns around, things are going to be better. But that's the hold up right now. So hopefully, I've been able to say something that'll help you to think through what you're dealing with. And I appreciate Ag Georgia giving me the honor, the opportunity to present to y'all. Corey, I'll turn it back over to y'all.
All right. Thank you, Don. We appreciate it. I know we went a little bit over, but there was a lot of good information there. I do want to open it up for some questions if anyone has one of those. If you join via Teams, drop it in the chat. If you have a problem with the chat, just raise your hand. If you joined over the phone, like I said, you can raise your hand pressing *5, and then I could unmute you and allow you to ask a question. So do we have any questions before we jump off the webinar. Give it a few moments. And maybe that you explained it so well, Don, no one has any questions, right?
I don't know.
All right. Well, we'll leave it there. If you have any questions, feel free to utilize Don's email address there. You can reach out to me at ccottle@aggeorgia.com if you have any questions later about how to get a recording of this webinar. We will put it on aggeorgia.com later as well. And I hope everyone that joined today has a great planting season and a profitable cotton crop in 2025. So thank you for joining.